Welcome to Cryptonomics. With two of the biggest marketplaces in the world introducing futures on Bitcoin, we wanted to dig deeper into how this will affect the prices on Bitcoin.
Both CME and CBOE will introduce Bitcoin futures trading, and currently it looks like CBOE will beat CME to the market with introducing Bitcoin futures as soon as 10th of December this year.
So instead of going into the technicals of futures trading and how it works, we wanted to dig deeper into how futures will affect the Bitcoin price. But first, a quick recap of what future is.
So a futures contract, or future for short, is a contract between two parties where they determine a fixed price and a fixed date where a transaction will occur. So a futures contract defines what kind of asset is traded, at what price, and at what date.
So let's say I want to buy Apple stock, for example, and I say, well, January 1st, 2018, I think Apple stock will be worth $170. So the person buying the stock, me in this case, will buy a contract which specifies the date and price, and the seller sells the futures contract to me.
And when we arrive at the 1st of January, the contract is settled. That means Fabian has to pay up $170 and the seller will have to give him one stock of Apple.
Now, if the price of Apple goes up during this time, I made the difference between the price now and the price at the end of the contract.
And this is what drives the prices of futures contract. So, why is Bitcoin futures such a big deal? It all boils down to three big reasons.
So in our last video, we talked about smart money. Institutional investors like hedge funds have not previously been able to buy Bitcoin, at least not easily.
And sure, some have managed, but most are regulated in such ways that they cannot get any access to the Bitcoin market or the cryptocurrency market. With future contracts, Bitcoin will be available to the really big players, and this will probably drive enormous amount of money into the Bitcoin market.
As of now, crypto funds has about $2.3 billion under management. Compare this to the entire hedge fund industry, which has approximately $3.15 trillion under management.
As we all know, increase in demand drives prices higher, and a lot of increase in demand could drive prices a lot higher.
So there are many reasons why people would want to use futures contract, and one of the reasons is hedging. When you buy or sell a futures contract, you know what risk you're taking because you know what you will receive from selling and what would you have to pay. This is why most companies that are involved in some form of manufacturing are involved in the futures contract market.
Let's take corn for example. The corn farmer wants to know exactly how much he's going to make in the end of each month. So while the corn is still growing out on the field, he sells some futures on corn. This way he knows exactly how much he's getting paid and when. Sure, the price of corn might go up in this time, but missing out on profit is not as bad as not making ends meet.
In the case of Bitcoin, you can be sure that a lot of miners will sell future to make their income more predictable. Miners have to pay huge electricity bills every month, so having predictable cash flows is very important.
Cash is king, but predictable cash flow is queen.
So now's the part when things get really messy. Shorting Bitcoin hasn't been possible until now. If you don't know, shorting means speculating that the price will go down.
And a lot of people are watching the future markets to try and measure the sentiment. If a lot of people are short Bitcoin, this could be a negative sign and lead to selling. But shorting an asset also comes with a greater risk. You stand to lose more than you actually put in. If I buy a stock, for example, I can never lose more than 100%. It can never go beneath zero. But if I go short, well, the price could double, and then that means I lose twice as much as I put in.
Historically, being short Bitcoin has been a tremendously bad trade. Since inception, it has gone up 1.4 million%. If a lot of investors go short Bitcoin and the price keeps skyrocketing, it will lead up to something called a short squeeze.
A short squeeze means that the shorters have to cover their positions to stop their losses, and this means that they have to buy the asset instead, which will push the price even higher. So in conclusion, Bitcoin futures is a huge deal and no one knows for sure exactly how it will affect the market.
Probably we will see huge price movements in the short term, but in the long term, futures contracts tend to stabilize the markets and make them more effective.
Institutional money or smart money is often more stickier. A $1 billion hedge fund probably won't buy today and sell tomorrow, while a retail investor might panic and sell when he sees a 10% down movement.
Some mean that the fact that these contracts on Bitcoin are cash settled means that it won't affect the price of Bitcoin, but this simply is not true. A cash settled contract means when the contract expires, the deal is settled in fiat and not in the underlying asset.
This is to avoid the hassle of delivering Bitcoins safely to the hedge funds or whoever invest in these contracts. So if no Bitcoins are actually exchanged, why would the futures price drive the price of real Bitcoins? Well, this is because of arbitrage.
If the price of the futures move in a different direction than Bitcoin, investors will take advantage of this price dissimilarity.
This is basically a risk-free trade, and this kind of arbitrage is what a lot of high-frequency traders and algorithms are focused on finding. If the futures contract for Bitcoin trades at, let's say, $12,000 and an actual Bitcoin trade for $10,000, well, you stand to make $2,000 in a risk-free trade. But everybody knows that there's no such thing as a risk-free trade. So if this arbitrage is present, well, people will take advantage of it and the market will adapt. It will get more effective. This means that the futures market will always bleed into the Bitcoin price.
So make sure to keep a close track on the prices on the 10th of December because we're probably in for a wild ride.
If you like this video and want more of Cryptonomics, hit that subscribe button and please leave a comment.